Your revenue looks great, but your bank account? Not so much. If you're an online coach, course creator, or community owner, you need a cash reserve. Cash flow issues are the number one reason businesses fail. In fact, 82% of small businesses fail because of it. But having a cash reserve is more than just an emergency fund. It's what lets you make smart investments, scale confidently, and avoid financial stress. I'm going to walk you through how much cash you actually need in reserves, how to build it step by step, and some ways to improve cash flow. First, let's talk about why cash flow and cash reserves matter. Cash flow is the movement of money in and out of your business. I love what Sarah Blakely, the founder of Spanx, said about it. She said, building cash reserves isn't just about surviving tough times, it's about seizing opportunities when they arise. I love that quote because it removes the stress side of managing and optimizing cash flow. It's a slight mindset shift that says, okay, building cash reserves for my business is not only the foundation, but it also opens opportunities and allows me to act more swiftly. Sarah is right. When you have sufficient cash on hand, you are in control. You can invest in the right team members, scale ads, and launch new offers without scrambling for money. But without reserves, you're operating paycheck to paycheck, which leads to rushed decisions and missed opportunities. So, what's the goal here? Move from survival mode to growth mode by building a safety financial net. Now, let's talk about how to build and manage your cash reserves. Let's break it down step by step. Step 1, determine your monthly operating expenses. Create a list of all recurring expenses for the last 3 to 6 months and calculate the average of the time period you selected. These are items you pay over and over again. It could be monthly, quarterly, or even annually if you're taking advantage of a discount for paying in full. They include software subscriptions, payroll, either for yourself or for your team, amounts you pay for consulting or ongoing training and education, advertising, taxes, etc. The easiest way to do this is to just generate a profit and loss statement from your accounting system and look at total expenses. Step 2. Set your reserve goal and compare it to where you are today. Traditional advice says 3 to 6 months of expenses is sufficient, but I say 6 months is the minimum, and ideally you want to aim for 12 months, especially if you rely heavily on paid ads or launches. So, take the average expense you calculated in step 1 and multiply by 6 months or 12 months to get your goal. And then subtract the amount you currently have in reserves to see how that compares to your goal. You now know what to work towards and what to track. Step 3, use a cash allocation system to set aside and monitor your cash reserves. I suggest putting the cash into a separate savings account, and if you're using QuickBooks for your checking account, you can use the envelope system that's built into the software. And as a quick side note, the envelope system is cool because it's a budget management tool that helps you visually see where your money is being allocated across different areas. Regardless of what you select, I suggest setting aside a set percentage of revenue into the designated reserve account. A good place to start is 10 to 30% of revenue, but of course you must ensure your current margins allow for that, and you may have to move things around while you're building reserves. So look ahead, see how long it'll take to build the reserves, and monitor your progress each month. And here's a pro tip. You can automate the transfer so you know it's already taken care of. And remember, even if you build cash reserves, cash flow mistakes can hurt your business. So here are some ways to improve cash flow, especially if you find it difficult to set aside money to build reserves. Number 1, plan ahead. If you're planning to launch a new marketing campaign or planning to hire, remember that it takes time to see your return on investment. Estimate when you're likely to see the return and determine when it makes sense to make the investment. If your cash reserves are already sufficient, it might make sense to operate with lower than normal profit margins for a short period of time to allow for the increased expense while you're waiting for your revenue to increase. And certainly keep a close eye on this during the testing phase and know the metrics you'll use to determine if a pivot is necessary. You may also choose to use money that's sitting in your reserve fund as long as you have a solid plan for replenishing it. And when you're coming up with the plan to replenish, look at various scenarios ranging from meeting your goal fully to completely missing the mark. Now, obviously, you'll be successful, but I still suggest that you be strategic and work through a plan for the unexpected. This also helps you think creatively. Number 2, manage payment terms and leverage credit responsibly. Hold onto your cash as long as possible by paying invoices when they're due. Avoid the allure of paying expenses early just because you have the money. If a vendor's terms are 30 days, pay on the due date, not when you receive the invoice. Leverage credit where you can. Also, consider opening a line of credit. We build wealth by leveraging credit in a healthy and sustainable way. A line of credit is a great way to borrow before you need it. It's a safety net that's great to have, as it'll be there for you if you ever get into a bind or if you choose to use it strategically. Number 3, reduce unnecessary expenses and optimize revenue by regularly evaluating your operations. It's best practice to operate in a manner that's lean but doesn't sacrifice the quality of offering your service and does not sacrifice the quality in which you treat your team. It takes some time to figure out that balance, but it's worth it. And when you review your expenses, think from this lens and make sure you are spending money on items that are necessary to operate your business and items that add value or help drive results. And when you review your revenue, check that your prices are adequately set and always evaluate your best sellers. Check how your effort is being allocated and the results to make sure they align. And number 4, use a cash flow forecast, which shows you your estimated future cash inflows and outflows. You can use this to spot trends, plan, and ensure you're prepared for future activity. Your accounting software likely does a very basic level forecast and looks at your history and predicts your cash flow. Your bank may also do some version of this. You can use the forecast from your accounting system as a great starting point, but I encourage you to do a more detailed forecast as your software doesn't know what's in your head and what you have planned for the future. I also recommend doing a forecast of future revenue, expense, and profit. When you have that type of forecast, you can really see the full picture of what you expect to happen in your business. So, in summary, cash reserves give you the financial security to grow a sustainable business. If you're not sure how much you need or how to forecast your cash flow, I've got you covered. I welcome you to join my free Skool community where I help online business owners like you with cash flow, profit, and tax saving strategies to help you scale strategically and keep more of what you earn. You can find the link in the description of this video. I look forward to seeing you inside the community.